What if you invest $100,000 in the best 3 value ETFs? Ever felt stuck between chasing growth or securing steady income through dividends? Here's the deal. You don't have to choose. Value ETFs offer the perfect balance. And with the S&P 500 trading at sky-high valuations, a market correction could be around the corner. Value ETFs, known for their resilience in turbulent times, might just be your smartest move yet. Ready to play it smart? In this video, we are breaking down 3 top value ETFs that can help you balance dividends and capital appreciation. We'll dig into their strategies and holdings to show exactly how they generate both growth and income. Starting with good and building to the best. Stick around to the end to discover an ETF that could potentially turn $100,000 into a jaw-dropping $3.6 million in just 30 years. Let's get started. First off, think of value ETFs as the perfect middle ground you didn't know you needed. While they may not grow as fast as growth ETFs, they strike a balance, offering steady dividend income and slow but reliable price growth. They're a low-stress, long-term choice for building wealth without betting everything on high-risk strategies. And here's the proof. Value ETFs typically pay a 2 to 3% dividend yield, which outshines the tiny payouts from growth ETFs, less than 1%, but falls just below the 3 to 4% yield from dividend ETFs. Why value stocks make sense this year? Growth stocks have been booming, but they come with sky-high valuations and higher risks. If the market takes a downturn, these could be hit hard. Value stocks, by contrast, are more stable, often undervalued, and tend to hold up better during market volatility. This year, choosing value ETFs could mean less risk and more reliable returns. Now that you know why value ETFs might be the smart play, let's dive into the details. VTV. The Vanguard Value ETF, VTV, is like a curated playlist of solid, dependable companies that might not be the latest hits, but have stood the test of time. For its strategy, this fund focuses on value stocks, which are shares of companies considered to be undervalued relative to their fundamentals, such as earnings and dividends. By investing in these companies, VTV aims to provide investors with steady growth and regular income over the long term. In terms of performance, VTV has shown resilience in various market conditions. Let's consider the periods when tech stocks experience significant declines. VTV's focus on value stocks helps it maintain more stable returns. This stability makes it an attractive option for investors looking to balance their portfolios with less volatile assets. One cool thing about the Vanguard Value ETF, VTV, is how it spreads out its investments. Its portfolio covers a wide range of industries with some of the most well-known and reliable companies. As for sectors, VTV leans heavily on finance, healthcare, and energy, which are traditionally more stable and less flashy than tech. Its key holdings include giants like Berkshire Hathaway, ExxonMobil, Johnson & Johnson, and JP Morgan Chase. These are all heavy hitters in their respective fields. Another thing to note? Its top 10 holdings make up just 21.2% of the entire portfolio. This is a clear indicator that it is a well-diversified fund. To prove VTV is a solid mix of steady income and long-term growth, let's take a look at its metrics. To begin with, it pays a 2.24% annual dividend yield, giving you regular cash flow just for holding your shares. On top of that, the dividends grow at a rate of 6.65% per year, meaning your income keeps increasing over time. But that's not all. The share price itself has delivered an impressive 10.10% annual growth, adding even more value to your investment. Now, let's break down what your investment in the VTV could look like over time, starting with $100,000. After 5 years, your dividends could grow to around $3,600 annually as the payouts increase, thanks to the 2.24% yield and dividend growth. Meanwhile, your portfolio grows significantly, reaching approximately $179,000, factoring in the 10.10% annual share price increase. After 20 years, here's where compounding really shines. You'd be earning $21,000 annually in dividends. Even better, your portfolio value would soar to around $1 million. By the 30-year mark, your dividends jump to $66,000 annually and around $5,500 per month, and your portfolio? A massive $3.3 million, all from steady growth and reinvestment. It's the power of patience and compounding working together. Another great value ETF to consider is SPYV. SPYV is the SPDR Portfolio S&P 500 Value ETF. As you can imagine, it is a curated collection of solid, dependable companies within the S&P 500 that are considered undervalued. For its strategy, it focuses on value stocks with the sole aim of providing investors with steady growth and income over time. SPYV is well diversified, with its top 10 holdings making up only 19.3% of the portfolio. In terms of sector exposure, SPYV had significant investments in the healthcare and financial sectors, which are traditionally more stable and less volatile than sectors like technology. This diversification helps balance risk and potential returns. Some of its key holdings include reliable giants like Berkshire Hathaway, ExxonMobil, United Health Group, and Johnson & Johnson. These companies are known for their strong fundamentals and steady performance, making them staples in the value investing world. The SPYV combines steady income with impressive growth potential. It offers a 2.25% dividend yield, meaning you get regular cash flow just for holding your shares. But here's the kicker. Its dividend growth rate is a massive 43.61% per year, which means those payouts could grow quickly over time. Although we believe that such an extra high dividend growth rate could normalize in the future as market conditions shift, it shows SPYV's strong momentum in delivering increasing income to investors. On top of that, the ETF's share price has delivered an annual return of 10.40%, making it a strong choice for long-term capital appreciation. This combination of fast-growing dividends and solid price growth makes SPYV a compelling option for anyone looking to build wealth steadily over time. But don't just take our word for it. Let's see how investing $100,000 in SPYV could grow over time. After 5 years, your annual dividend income increases to $3,700, showing how fast those payouts grow. Meanwhile, your portfolio value reaches approximately $181,000, steadily compounding year after year, reflecting the 10.40% share price appreciation. By 20 years, this is where compounding takes off. Your annual dividend income skyrockets to nearly $22,000 due to the incredible dividend growth rate. Your portfolio value grows to a solid $1 million, a big leap from your initial $100,000 investment. After 30 years, the numbers are astounding here. Your annual dividends hit $72,000. Yes, that's over $6,000 per month, with your portfolio value reaching approximately $3.6 million. When comparing SPYV to VTV, one key difference is the sector breakdown. Both ETFs share similar top holdings like Berkshire Hathaway and JP Morgan Chase, but their sector weightings reveal a difference in focus. VTV seemingly leans more toward the energy sector, which is known for stability and consistent dividends, while SPYV places more emphasis on the technology sector, capturing growth opportunities from the tech-driven value stocks. Now for the big gun, SCHV. In similar fashion, Schwab US Large Cap Value ETF, commonly known as its ticker SCHV, is designed to give investors exposure to large US companies that are considered undervalued. For its strategy, it tracks the Dow Jones US Large Cap Value Total Stock Market Index, which includes a broad range of large cap value stocks. One of the appealing aspects of SCHV is its diversification, with the top 10 holdings constituting only 19.1% of the fund's total assets. This means your investment isn't heavily reliant on just a few companies. Key holdings in SCHV include industry leaders such as Berkshire Hathaway, Johnson & Johnson, and ExxonMobil. These companies are known for their strong performance and stability. In terms of sector exposure, SCHV has significant investments in financials, healthcare, and energy sectors, providing a balanced mix that can help mitigate risk. SCHV is all about balance. It offers a 4.25% dividend yield. This, of course, is notably higher than most value ETFs offer. However, the dividend growth rate is 2.40% per year, which is on the slower side compared to some others, but it still ensures your payouts keep up with inflation over time. On top of that, SCHV's share price grows at an 8.40% annual rate, giving you a mix of steady income and long-term capital appreciation. If you need any more proof that this is a slow and steady wins the race kind of ETF, let's look at the numbers. If you start with $100,000 invested in SCHV, so by year 5, you'll be earning around $7,000 in dividends, and your portfolio will be roughly $182,000, thanks to an 8.4% annual return on the stock price. Fast forward 20 years, and that same $100,000 could be worth almost $42,000 in dividends and a portfolio value of dividends now accumulating to over $1 million. If you stick with it for 30 years, your annual dividend income could be hitting around $139,000, and your portfolio might balloon to $3.6 million. Pretty wild, right? There are a couple of things to note though. When comparing SCHV with VTV and SPYV, the key difference again lies in the sector breakdown. While all three ETFs share similar top holdings, like Berkshire Hathaway and JP Morgan Chase, their sector focus sets them apart. SCHV stands out with a heavier allocation to the technology sector, giving it a modern edge compared to its counterparts. This focus allows SCHV to benefit from the growth potential of tech-driven value stocks, blending innovation with stability. So if you're someone who wants value stocks, but likes the idea of tapping into the tech sector's momentum, SCHV would be the most exciting option. While both SPYV and SCHV could grow your portfolio to over $3.6 million over 30 years, the difference lies in the income they generate. SCHV's dividends are nearly twice as high as SPYV's, thanks to its 4.25% yield compared to SPYV's 2.25%. This makes SCHV a fantastic choice for those seeking a value ETF with stronger cash flow potential alongside long-term growth. Yes, you can have it all: steady income and long-term growth. Value ETFs like VTV, SPYV, and SCHV offer the perfect mix of stability, dividends, and growth. Whether you lean toward energy, tech, or a balanced portfolio, there's an option for you. The key is choosing one that fits your goals and staying focused on building wealth steadily over time. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.